You work hard for years. Save every dollar. Finally get $300,000. And one decision quietly decides your entire financial future. A house. Or the stock market. Same money. Completely different life. And almost nobody realizes what's really happening here. Most people think buying a house is always the safe move. It feels responsible. Stable. Normal. But there's another option people rarely think deeply about. What if that same $300,000 was never turned into walls and a roof, but into ownership of companies that run the economy? This isn't just a money question. It's a time question. A freedom question. And the surprising part is, most people don't realize they're making a choice that affects the next 20 to 30 years of their life. But here's where it gets interesting. Because the obvious answer might not be the real one. And once you start looking closer, it's not just about money on paper. It's about how we're taught to think about money from the very beginning. I've been exploring personal finance for a long time, and one thing is clear. Small decisions quietly shape your future. Let's start with the house. You put $300,000 into a home. It feels real. Tangible. Safe. You walk inside. You see rooms. A kitchen. A backyard. And every month, you pay the mortgage. At first, it feels like you're building something. But here's what most people don't think about. You're not just buying a house. You're locking yourself into decades of payments, maintenance, taxes, repairs. And slowly, your investment starts to feel more like a responsibility than an asset. But still, everyone says, at least you're not throwing money away on rent. That line feels comforting. But it's not the full story. And this is where the first confusion starts to build. Now imagine something different. Same $300,000. Instead of a house, you invest it into a broad stock market fund. You don't see bricks. You don't see walls. You just see numbers moving quietly in the background. At first, it feels boring. Even unsafe. Because nothing physical is there. And that's exactly why most people ignore it. But here's the tension. While the house sits in one place, the economy keeps moving. Companies grow. Technology expands. Profits compound. And your money is quietly tied to all of it. But nobody tells you what that actually looks like over time. Let's pause the emotion for a second and look at behavior. Historically, housing tends to grow slowly over long periods, but with major local differences depending on city, timing, and maintenance costs. Meanwhile, diversified stock markets have historically delivered long-term growth driven by business expansion and reinvested profits. But here's the key point most people miss. It's not just about growth. It's about reinvestment. A house doesn't automatically multiply itself. But companies do. And that creates a silent gap that grows over time. At first, it's small. Almost invisible. But then years pass. And something strange happens. Let's fast forward 10 to 20 years. The homeowner looks successful. They say, my house value went up. But then reality shows up quietly. Taxes increased. Repairs happened. Interest was paid. Time was spent maintaining it. Money was locked inside it. Now the investor. They didn't manage a property. They didn't fix anything. They didn't call contractors. They just stayed invested. And something unexpected shows up. The gap is no longer small. But here's the part nobody talks about. Because the real difference isn't just money. It's flexibility. A house feels stable. But stability comes with a hidden trade. Illiquidity. You can't easily turn a house into cash. You can't split it. You can't instantly move it. So life decisions start getting filtered through it. Can I change cities? Can I take that job? Can I slow down work? Meanwhile, the stock investor has something different. Optionality. Their money isn't locked to a location. It moves with them. And that creates a psychological shift most people don't notice. One path builds attachment. The other builds flexibility. But here's where it gets worse. Because both paths feel correct at the beginning. If you're still watching, this next part changes everything. Because the real issue isn't house versus stocks. It's what people think each one is supposed to do. Most people believe a house is how you build wealth. But that's only half the story. Because a house is also consumption. You live inside it. You use it every day. It gives comfort, stability, identity. And that creates a hidden bias. You start measuring it like an investment, while treating it like a lifestyle decision. Meanwhile, stocks are the opposite. They don't give comfort. They don't give identity. They just grow quietly in the background. So the mistake isn't choosing one or the other. The mistake is expecting both to behave the same way. And that misunderstanding is where most financial frustration begins. Let's zoom into real life. A homeowner might feel proud, but stressed by repairs they didn't expect, rising interest rates, property taxes, being stuck in one place. Meanwhile, an investor might feel uncertainty during market drops, emotional discomfort watching numbers fall temporarily. But over long periods, the biggest difference shows up in something else. Time. One path demands time, attention, and upkeep. The other demands patience. And most people underestimate how powerful not needing to manage something actually is over decades. Now zoom out again. 20 to 30 years. The house has likely increased in value, but also had years of costs, maintenance, and inflation adjustments. The stock portfolio, meanwhile, has gone through ups and downs, but stayed compounding. But here's the twist. The biggest difference isn't even the final number. It's what you could do along the way. Because one path ties your life to a single asset. The other keeps your options open while it grows. And that changes everything about career decisions, stress levels, and freedom. This isn't about saying houses are bad. That's not the point. A home can give stability, safety, and emotional grounding. But it's not a pure wealth engine in the same way a diversified investment portfolio can be. And stocks aren't a perfect solution either. They don't give you shelter. They don't give you comfort. But they do something different. They let the economy work for you instead of you working for stability alone. So the real question was never house or S&P 500. The real question is, what do you want your money to do for your life? Because once you understand the difference, you stop following what feels normal and start building what actually fits your future. Two paths. Same $300,000. But only one quietly gives you more time, more options, and more freedom over the years. And the hardest part? Most people only realize it when time has already passed. By the time you notice the difference, you're already living inside it. If this helped you see things a little differently, you can subscribe for more simple breakdowns like this.